Welcome back to the Gold and Alternative Investment Show. My name is Kerry Stevenson, and today I'm absolutely delighted that I've managed to grab hold of Jordan Eliseo. He is the Senior Investment Manager for the Perth Mint. And I've known Jordan for some time. He's a market commentator. He's worked in the financial services industry for over 20 years, and his background includes investment research, investment management research and asset allocations for institutional portfolio managers, both in Australia as well as overseas. He's written a couple of books on gold, and today I wanted to bring Jordan on to talk about what's happening in the gold space in this time. What does it look like today compared to the GFC? What's the macroeconomic outlook? Because Jordan doesn't just focus on the gold sector. He also understands what's happening with the economic indicators. So Jordan, welcome to the program. Great to see you.
Thanks, Kerry. Thanks for having me on.
Well, let's start with the economics of where we're at the moment. And given your economic background, what's your views on where we are at the moment economically without focusing just on gold?
Well, I think economically we're in a pretty tough space right now. So obviously, if you look at what's happened around the world in the last sort of 2 to 3 months, as governments have taken the sort of necessary steps to control the spread of coronavirus, we've seen an enormous decline in economic activity and the obvious fallout following through to a significant rise in unemployment. So I think in the United States now, we're up to almost 30 million people have basically filed for jobless claims or have lost their jobs. And here in Australia, we're talking the better part of 10% of the country is officially unemployed. The number looks lower than that because we've seen a decline in the participation rate. And there's been I think now over 6 million people have applied for JobKeeper. So from an economic perspective, we are in uncharted and very troubling waters. The decline in activity that we're seeing is on a scale that far exceeds what we saw in the GFC over 10 years ago. So it's a difficult environment for anyone, investors, policymakers, people just trying to put food on the table and do their job. So it's a very tough environment. It's no surprise that that's feeding through to volatility in financial markets, emergency policy stimulus, and of course it's impacting gold as well.
Yeah. Do you think though that it seems like, especially here in Australia, a bit of an island here, and we seem to have managed the pandemic quite well. And do you think that people feel like the worst is over, we'll be getting back to normal fairly soon, and so the economic damage won't be that bad? And what is your view on that? Because do you think that the government stimulus is giving us a sort of a false start, if you like?
It's a great question. I mean, I was out on the weekend as my daughter's second birthday, and so obviously we couldn't have a big party like we did for her first birthday. But, it was great to see sort of people out and about down at the park and, using playground equipment. Shops were busy, people were at cafes, you name it. But I think what's going to be really interesting is to see how long that lasts for. And there's two reasons I say that. I think that, one, it's natural as restrictions are eased, people's first reaction is to sort of go out and socialise again because it's the first time they've been allowed to for a period of time. But I think there's 2 points that are really important here. One is that the threat from coronavirus is not over. We sort of can't, sort of wrap it up in a ball and say, okay, well, the challenge has now been dealt with and it's just a case of getting back to normal. So the ongoing threat is still there from a health perspective. And then, as you point out, there's been such an extraordinary amount of stimulus thrown at the economy, and basically, giving people some money so they can keep, paying for the basics. That's going to help us for a short period of time. But of course, there's going to be some uncertainty there because if you're on JobKeeper or the increased payment that's come through for JobSeeker, if you start to think, well, hey, this is only going to last until September. then you're probably going to sock a little bit of that money away. You're not going to go back or go out and spend in the way that you normally would if you were comfortable and confident in your gainful employment, if that makes sense. So I think those that are expecting a sort of V-shaped economic recovery are probably going to be mistaken or disappointed. I think this is going to take a long time to play out, and I think it'll be years before we get back to the level of economic activity that we were sort of enjoying, for want of a better term, at the start of this year.
And so the difference between where we are now and the GFC, obviously the GFC was a nasty hit at the time. We got over it. Share markets went back to all-time highs. And in fact, right now, the share market is showing signs of quite a nice recovery, a drop of 37%. I think it's recovered like back up to, we're almost back to where we were. Is that should people be a little more wary of a sort of, it's almost like a dead cat bounce?
Look, it has the potential to be, and markets sort of already look like they've, I wouldn't say hit a brick wall, but they're sort of certainly starting to come up against a significant amount of resistance after the very, very strong rally that we've seen from late March. There's a few factors at play. Obviously, we've seen policy stimulus both on the fiscal side from government and on the monetary side from central banks, which again, if anything, is blowing out of the water what we saw in the GFC. So it makes sense why there's a bid in equities. It also is worth pointing out that the yield environment is significantly different today. So if you go back to when the GFC hit, across 2007 and 2008, US Treasury yields for 10-year Treasuries averaged around 4%. So 4% return for lending to Uncle Sam is pretty solid. Today they're lower than 1%. So from a diversified portfolio perspective, and indeed rates are negative pretty much all around the world in real terms. From a diversified investor perspective, you sort of almost have to own equities to one degree or another. So I think that will provide some kind of ongoing support for markets. But the real swing factor here is actually going to be developments on the health front. Can we find a vaccine? Are there going to be clusters? Or the vaccine's not going to come tomorrow, but it doesn't look like we're on a path to getting one. Are there going to be clusters of COVID-19 emerge? And we have seen that, sadly, in some countries which have tried to ease restrictions. They haven't then had to go and completely lock things down again, but there have been sort of areas of the community or the economy where they have. So I think that's going to be the real swing factor, because if you think about the way markets have reacted, they've essentially said, okay, well, we're seeing all this fiscal and all this monetary policy stimulus, so that's good for equities. Plus, we're sort of looking through the worst of the COVID-19 threat. We're looking through the worst of the sort of earnings downgrades that we're seeing. But if a bit of fear comes back into the market that actually, we're not going to be able to go back to any kind of sort of normal economic environment anytime soon, you could see fairly significant downside. There's no question about that. It is a risk that will be there for the foreseeable future.
And what's your view on how that, let's bring that thing, because I say to people, they all know me, I'm a gold nerd. Given all of that commentary around the economic outlook, what does that impact in your opinion? Now, look, you're the senior investment manager at the Perth Mint. Obviously, you see a lot of what's going on in that gold space. What do you feel is the outlook for gold from an investment point of view? And you understand gold extremely well, but there's a lot of people out there, Jordan, that maybe they're investors and they're looking and they're scratching their heads and saying, well, I don't even know what gold is. Should they be starting to educate themselves? Because I always say to people, be resourceful, get educated. If you're talking to people out there that don't understand gold, and I've actually had quite a few people say to me, I don't even know where to start. And if you go on to the Perth Mint website, for example, there's a lot of different options for them. What would your advice? So there's two questions there, I guess, is what's your outlook for gold, and how does an investor that doesn't even understand this sector get started?
Sure. So look, I think over the medium to long term, the outlook for gold is pretty positive, and so I believe prices are biased to the upside, as it were. And there's a handful of reasons for that. At the end of the day, investors have to have their money in something. Now, the four most liquid simple asset classes in the world are equities, bonds, cash, and gold. Cash is paying negative real rates pretty much all around the world. The vast majority of the fixed income or sovereign bond market is paying negative real rates or very low rates. And equities are basically priced, if not to perfection, at the very, very upper end of historical norms and at the kind of levels that we've typically seen significant bear markets start from. So if you sort of think, okay, there are four areas on the board I can put my money, the other three, but before we even get to gold, all have significant risk in them right now. And so
I'm going to stop you there just for 1 second, because
sure.
you mentioned equities, bonds, cash, and gold. And here in Australia, people get very excited about real estate. You haven't actually mentioned that as a potential option.
Yeah, sure. So sorry, I'm starting with the sort of liquid asset classes. So
okay.
We can get to real estate in a second. So if we just look at the as I say, that liquid space, there is a very, very clear reason to say, well, actually, it makes sense to have some gold in my portfolio because there are risks in these other spaces, and gold actually is typically the one asset that thrives whenever there's greater stress in equity markets, or if people want to move out of bonds, or they're worried about low real rates on cash. So I suppose that's a big reason why I think the outlook for gold is both gold demand and gold prices is relatively positive over the medium to long term. It is worth pointing out though that gold's had an incredible run over the last 18 months. So if we go from sort of September 18 to March 2020, in US dollar terms, it basically recorded a positive return in each of those 6 calendar quarters and was up around 40% over that time period.
Wow.
In Aussie dollar terms, it was up closer to 60% because the currency fell as well. So, a period of consolidation here would not be unexpected. The price could very easily continue to ratchet higher, and indeed there are many analysts expecting that to happen imminently. I'm not saying I disagree with them, but I think from any balanced observer should note the fact that gold demand's been very strong of late. Gold prices have been very strong over the last 18 months. So, a bit of a short-term hiatus is not a bad thing for the market either. Moving on to property, look, I mean, I think if you look at most Australians, the dream will always be to own a home. And there are a myriad of very good reasons to do that. The challenge in Australia now is, and it's been a challenge for some time, is personal debt levels are at all-time highs. Rates are at all-time lows. So you've already had the tailwind of low rates making it easier to borrow more money, if that makes sense.
Yeah.
You can't do that again. Rates have gone from circa 15% to basically zero. They can't go to minus 15.
Well, they might.
Well, if they do, then we're in an entirely different world, and I'd posit the theory that a world of negative real interest rates is probably going to be pretty positive for gold too. So I think that's for those reasons, gold is an asset that investors should look at. The second part of your question was, relating to sort of how to get started or what investments or which gold investments to choose.
But for somebody that's never looked at this, but understands that, there are interest rates, having your money in cash and getting nothing for it, they're looking for what to do, but they don't understand investing in gold. So then they'll go onto the Perth Mint website and go, where do I start? So some advice on that for our newcomers out there would be very handy.
Sure. I'll just be a bit clear up front that can't give advice per se, but I can give information. So from that perspective, look, there are essentially three main ways you can invest in gold. You can buy a bar or a coin that you choose to store at home or store in a private vault, and obviously the Mint is a major global player as a producer of bars and coins. We export them all around the world, and indeed obviously sell them to investors here in Australia. Now, a lot of investors still love doing it that way. There's nothing like actually holding an ounce of gold in your own hand and sort of feeling that tangible wealth. Although quite naturally, some investors say, well, hang on, then I've got to worry about storing it myself. And so I'm not so keen on that idea. So then the second option is that you actually have what is called effectively a depository account with an organisation like ours. So not only do you buy and sell your gold through us, but you actually keep it with us in the meantime. So it never actually leaves our custody. And the benefit of that, particularly with an organisation like ours, is that you have a government guarantee underpinning all of the precious metal holdings. So it's we would argue the most secure place to store your precious metals. So that's another option. And again, that way the client or the investor has exposure to the price of gold. It's incredibly liquid. They can buy it and sell it 24 hours a day, but they don't need to worry about, well, where am I going to store it? How do I get it back to you if I want to sell it? You name it.
And Jordan, on that note, is there a cost for them doing that? So, for example, I'm just bringing it out there to people that, if they were to use the depository service, is there a cost for them holding it with you, or is it purely based, I buy it at this price, and if I want to sell it?
Yeah. So there's two ways to own gold through the depository. One does have a cost. That's when you buy allocated gold. So that's when you're buying a specific bar or coin that is allocated to you. You as the investor have clear direct title to that one specific product. And the charge for that is 1% per annum of the value of the gold. The other option, and this is incredibly popular with the vast majority of our client base, is what we call unallocated metal. Now, in the case of unallocated metal, you're not buying a specific bar that you have legal title to. You're buying into effectively a pool of gold that the Perth Mint is using in its refinery, minting business, you name it. Now, the advantage of unallocated gold to the end investor is that there's no storage fee. So you basically just pay a transaction fee when you buy it, a transaction fee when you sell it, but you're not paying any storage fee for the duration of your investment. So it's an incredibly cost-effective way, obviously, to own gold in your portfolio. And I would say somewhere in the vicinity of sort of 70-ish% of investors that use the depository buy unallocated metal.
70%. And do you think that's just because it's easy? They can set up an account, put some of their, I call it funny money.
Yeah, I think there's probably three key reasons. The first and most obvious one is there's no fee involved from a storage perspective. The second is that actually from an investment perspective, the beauty of unallocated gold is that you can actually invest specific dollar amounts because you're not having to buy exactly 1 ounce or exactly 2 ounces. So let's say, for example, right now, gold is roughly $2,700 an ounce. So if you want to buy 2 ounces, you've got to spend $5,400, right? Because that's what 2 ounces cost. Where if you want to say, actually, I want to just put $5,000 in gold, right? That's not enough to buy exactly 2 ounces, but you can buy $5,000 worth of unallocated because we will just credit that would work out at about 1.7 ounces to your account. So it's actually in some ways easier to buy it in unallocated form because you can invest specific dollar amounts. And that's why actually a lot of people use like a regular savings plot program where, once a month they're sending us $500, $1,000, $5,000, and we're converting that, buying gold with it or silver on their behalf.
And it's interesting. And I think that's what people need to know. It's not that difficult.
No.
It doesn't have to be, there's no minimum amount, if you wanted to make it $50 a month.
Yeah, but buying gold is just as easy as buying shares. And in fact, the third reason investors are comfortable using the unallocated solution is because of that depository security that the Perth Mint offers due to its government guarantee. So there's an understanding that their investment is secure. It doesn't mean the price of gold can't go up and down, but there's security in their investment that is essentially unmatched globally. The third way, though...
Sorry to interrupt you there. I just want to focus on that government guarantee. Perth Mint is backed by the West Australian government. How does it work, and why should people be comfortable that there's that security level?
Well, so Perth Mint is owned by the Western Australian government, and as per the Gold Corporation Act, which is effectively the act which gives life to the Perth Mint as an operating entity, the Western Australian government stands behind the liabilities of the Perth Mint to its depositors, essentially. So that's effectively why there's that additional level of comfort. I mean, the other thing is, of course, investors can go to the Perth Mint's website and I think download the last 20 years worth of annual reports. You can see our balance sheet, the size of our turnover, you name it. There's a reason why the largest financial institutions on the planet are comfortable dealing with us, and why central banks will store gold with us, and family offices, sovereign wealth funds, you name it. It's because of that depository security and the reputation that the organisation has built in its over 120 years of operations. I wanted to also talk about and perhaps I should have started here, but there is a third way for investors to buy gold now very easily, which is just via an exchange traded product. And the Perth Mint has one of those on the ASX. The ticker code is PM Gold. So if an investor is already buying shares and has a portfolio that they manage either online or via their broker, if they want exposure to the Australian dollar gold price and they want to know they're buying a security or an investment essentially that is backed by the Perth Mint, then PM Gold trades like a regular share and can be bought and sold like an investor can buy shares in CBA or Telstra. And the way that product works is it's structured such that its value is worth 1/100th of an ounce of gold. So for every 100 units of it you buy, you effectively can make a claim on the Perth Mint for 1 ounce of gold. So if you were to see that the gold price is trading at, let's call it 2,700 Australian dollars an ounce right now, which is roughly where it is, then PM Gold will be trading on the ASX essentially at around $27 an ounce. And it will move up and down alongside the Australian dollar gold price. So we've seen an explosion in the number of investors using that. I think the registry for the product has essentially more than tripled over the last 18 months. So, that's the number of investors that are buying the product. So, that ease of use, again, if you've already got a broking account, you can just buy that, while the market.
Oh, I see. Okay, because I was going to say to you, why wouldn't I just buy unallocated gold? But it's traded on the stock exchange. Is that right?
Correct. That's exactly right. Yeah. So from an investor's perspective, if they say, well, I just want exposure to the gold price, I don't actually want to take possession of it or anything like that. If you've already got your broking account set up, then you'd look at that and go, well, I can literally just do this all via the ASX through my broking account. And there's no surprise why we've seen such an increase in demand for that product as well.
So really it's just people's perception that it's difficult because I had somebody I know quite well say to me, and I've actually told her that I was going to have a chat with you and I would bring up her question, which is, isn't gold too expensive? Have I missed the boat?
Yeah, look, it's a great question. So let's break that down into two parts. A lot of people look at the gold price at $2,700 an ounce, or they see those huge bars on the TV and they go, wow, that's worth $1 million. So they just sort of say, well, gold's not for me. I can't access this market. As we discussed before, you can get started in the gold market with as little as $50. If you think about the two biggest consumer markets for gold in the world are China and India. The average wealth and the average income in those countries is but a fraction of what it is in Australia. So if investors in those countries can access the gold market, your average Australian can absolutely get into gold. From the perspective of the price, as I mentioned before, I think, we could have a period of consolidation here, but prices, have likely bias to the upside. There are a lot of reasons to own gold in a portfolio. And I think that's the key thing as well. If you don't own gold, by definition, you've got 100% of your money in stocks, cash, bonds, real estate. And for a number of very good reasons, investors are choosing to move maybe 5, maybe 10% of their portfolio into gold. Now, of course, they're hoping the gold price goes up significantly, but even more important than that, they're wanting to diversify and protect their overall wealth. So, to your friend, and they've asked that question, if you go back to the GFC as an example, Now, in US dollar terms, in 2008, gold only went up by about 4%, but the market dropped by nearly 50. So, you know, if you said, okay, I'm going to buy this investment because it's going to go up by 4%, that doesn't sound particularly attractive. But if you made 4 while the market lost 50, well, you could now buy double the amount of shares. So from that perspective, I think from, you know, the diversification angle and that sort of whole of portfolio argument, there are a lot of reasons to be looking at gold or continuing to look at gold in you know, today's day and age or in the current environment.
Jordan Eliseo, it's been an absolute pleasure to listen to your views on gold, because you do have such a great understanding of it. If people want to get a hold of yourself or the Perth Mint, they can just go to perthmint.com. All the information is there. If they need to reach out to the Perth Mint, they can either email or call. And it's pretty simple to set up an account, I believe, with the Perth Mint.
Yeah, correct. That's exactly right. So we, you know, we've seen a huge influx of Australians opening accounts and getting started on their gold investment journey, and we are more than happy to help anyone looking to do so.
All right, so ladies and gentlemen, I'm going to actually just point out once again, because I say this all the time, hedge and diversify, because we don't, you know, as Jordan pointed out just then, we live in a very volatile market at the moment. We don't know whether the share market is going to keep its strength. We don't know what's going to happen to the real estate market. I always tell people, first of all, I am not a financial advisor. I am a gold nerd. I'm a real estate investor. I'm a serial entrepreneur. I'm always looking at opportunities, but please do your own research and get your own financial advice. This interview is purely for educational purposes. So do your own research, but I always tell people, hedge and diversify. Be resourceful, get educated, and make sure you keep watching our videos, because we're here to help you learn and understand how to protect and grow your wealth. Jordan Eliseo, thanks for joining us today.
Thanks again, Kerry. Cheers.